My name is Kyle French, Financial Advisor at WDS, and welcome everyone to our fourth quarter market commentary and updates video. Before I get started, I must state that this is provided for informational purposes only and should not be construed as investment advice. References to specific portfolios should not be considered a recommendation. Data and analysis does not represent the expected future performance of any investment product or strategy. Investments involve risk, including possible loss of principal. What a year it has been. We've gone from the beginning stages of the artificial intelligence boom to nearly defaulting on our national debt, to then having Taylor Swift keep the global consumer alive by having attendees spend thousands of dollars to attend her Eras tour this summer and fall. Let's dive in. Due to the advancement of artificial intelligence, there have been a handful of technology companies that have exploded in value. Some have coined the acronym MAGMA to quickly describe Microsoft, Apple, Google, Meta, and Amazon. The S&P 500, which is the most popular index to track U.S. stocks, can best be described as a market cap weighted index. This is a fancy way to say that the largest companies are a larger weighting within the index. These 5 companies have grown so substantially this year that they now make up a 23% weighting in the S&P 500 alone, which means the other 495 companies make up the other 77%. Therefore, if MAGMA stocks are doing really well, the S&P 500 is most likely going to do well. If they aren't, the opposite is likely. This is much different than the last tech boom in 2000, where the largest companies only made up 18% of the index at its peak. We also now have 2 U.S. companies, Apple and Microsoft, that have a bigger market cap than the combined market cap of all stocks in the Russell 2000 Small Cap Index. Instead of the acronym of MAGMA, some have decided to include the next 2 biggest companies, Tesla and NVIDIA. Investors have coined the term the Magnificent Seven to easily describe them. As of September 30th, the Magnificent Seven is up 57% on average this year, whereas the S&P 500 was up 12%. But if you were to take these 7 names out of the index altogether, the S&P 500 would only be up 1% during that same time, further strengthening the case for how powerful these companies have become. Switching over to bonds. So far, it has been the worst 3-year stretch of bond performance ever in its history. In 2021, the U.S. aggregate bond index fell 2% for the first time since 2013. This followed by a 13% decline in 2022, which was the worst year on record. This is because bonds perform best in a decreasing interest rate environment, the exact opposite of what has occurred as of late. At one time last year, the aggregate bond index was down 17% on the year, as shown by the red dot. So far in 2023, bonds are nearly flat on the year, after being down 7% at one point this year. This volatility in the fixed income space has driven investors insane. Since the last 4 decades, we have seen stable and reliable performance from bonds, since interest rates have just consistently declined since the 1980s. As of late, we have seen some major moves in the fixed income market. On Thursday, November 9th, the U.S. government attempted to issue $24 billion of 30-year treasuries within the open market, but the issue was the buyers weren't present. The auction ended at having a large tail, which essentially means that the Treasury needed to entice buyers with a premium yield over where the 30-year bond was currently trading at. This left 24.7% of these bonds to be issued to primary dealers, such as banks, who are considered to be the buyer of last resort, when no one else wants to buy them. This is more than double the average of the past year, while China, Japan, Saudi Arabia, and Russia all decided not to buy any bonds. And interestingly, we are seeing international buyers starting to sell our debt instead. America's largest foreign creditor, Japan, has cut its U.S. bond holdings to their lowest level since 2019. They're still by far the largest foreign owners of our treasuries, holding $1.1 trillion as of August, which is almost 40% more than Chinese investors. But the Bank of Japan is taking meaningful steps toward normalizing their monetary policy by possibly paving the way for its first interest rate hike since 2007. This could have important implications for U.S. treasuries if it pushes some of the biggest global investors to rotate out of the U.S. and back into Japan. Further complicating our fiscal situation is the unexpected announcement by the Treasury Department that it would borrow roughly $776 billion between October and December of 2023. The $1.76 trillion of treasuries that have been issued on a net basis through September is the highest level that we have seen in the past decade, excluding the 2020's pandemic surge. Official estimates suggest that this trend is unlikely to decrease, raising concerns about its impact on bond prices for years to come. Heavy borrowing means more issuances of treasury bonds, which unfortunately the two biggest buyers of the past decade are largely out of the market. The Federal Reserve, who's shedding its portfolio at a rate of about $60 billion a month, and China, who would rather not support the US economy at this time. This has led to overseas private investors and central banks now owning about 30% of all outstanding US government debt, down from roughly 43% a decade ago. In the past, it felt like the US Treasury issuance was limitless, since everyone wanted to buy the safest investment known to mankind. Moving to the Federal Reserve, at the latest Fed meeting in early November, Fed Chairman Jerome Powell hinted that the central bank might be done raising interest rates for now, but was careful not to rule out another increase after officials extended a pause in hikes. Powell echoed that the sentiment by repeatedly highlighting how much inflation had fallen rather than emphasizing the economy's recent strength like he had in previous meetings. Fed officials have now skipped a rate hike for 2 consecutive meetings, making it the longest period without an increase since they began to lift rates from near zero in March of 2022. Ever since then, they raised rates at the fastest pace in 4 decades to combat high inflation. The economic outlook has changed a little bit, though, in 2 major ways. First, inflation is starting to cool. Core inflation, which excludes volatile food and energy prices, peaked at 6.6% last year, but recently fell to 4% in October, which is the lowest in 2 years. The second being that financial conditions have tightened due to a fast rise in long-dated treasury yields, leading borrowing costs to rise for households and businesses. This increases the cost for mortgages, auto loans, and business debt, all of which could slow economic growth. Because of this swift rise in interest rates, it has had a negative effect on households. The average American debt has risen 21% in just 3 years, which at that pace, it would double in a decade. Delinquency rates on auto loans and credit cards continue to rise sharply, according to recent data by the New York Fed. Credit card debt is now well above $1 trillion today, and the personal savings rate is near a historic low. Also, according to the New York Fed, nearly 40% of US households now have more credit card debt than savings, with the average household having $10,000 in credit card debt today. This comes at a time where the average interest rate on a credit card is at a fresh record of 25%. On the housing front, on October 26th, the average interest rate on a 30-year mortgage rose to 8.09%, its highest since July of 2000. We have seen home affordability hit some of the worst levels on record. And according to Redfin, based on the median home value and using banks' 30% income rule, homebuyers are now required to have $115,000 of income per year to afford the median home value. This level used to be $75,000 in August of 2020, meaning in just 3 years, it has shot up by over 50%. This has led to the average house payment now being 48% of median income, well above banks' typical threshold of 30% when they issue a new mortgage. This has led to the worst level of housing affordability since the 1980s, when rates were actually double digits. But one major difference between these 2 time periods was that the average home price was 3.5 times the median income in 1980. Today, it's 6 times the median income. Switching to the auto loan market, the average new payment is at a record of $780 a month, with a new car loan rate record of 9.9%. Used vehicles, 13.9%, most likely contributing to an auto loan delinquency that's rising very fast today. With all of this being said, the good news is that a recent study, according to Reuters, says that 87 of 100 economists surveyed claim that the Federal Reserve is done raising interest rates for this cycle. 86 of the 100 believe that the Fed will wait until at least second quarter of 2024 before deciding to cut rates. While according to the widely followed CME Group FedWatch tool, the expectation is that the first interest rate cut will be in May of 2024, followed by 3 more quarter-of-a-point interest rate cuts for the year, bringing the front end of the Fed funds rate down from 5.25% to 4.25%, helping to provide some relief for businesses and consumers moving forward. Moving away from consumer debt and onto our national debt. Today, we find ourselves confronted with a daunting reality: Washington, D.C.'s unsustainable fiscal spending. Shown by the red line, the US debt to GDP ratio has reached its highest level ever. I love using this measure because due to inflation, we all know the US debt has increased over time. But how you can compare the debt level to the economy's past history is divide it by its total amount of output within the economy, which is its GDP, gross domestic product. The last time we were anywhere close to this level was after World War II. Incredibly, net interest on the national debt has rocketed past $1 trillion a year recently, which is shown in the blue, and is equivalent to 16.3% of the entire federal budget for fiscal year 2022. It took only 19 months to double our national interest owed per year. As mentioned earlier, in fiscal year 2023, the US ran a deficit of $1.7 trillion. The 2023 deficit is approximately 25% larger than the total Social Security outlays today. Or to put it another way, the government has borrowed more than 3 times the 2008 bank bailout to fund this year's deficit. Now, today we spend $889 billion on healthcare each year, Medicare, $848 billion, and national defense, $821 billion. Now making the interest expense on the debt the second largest expense behind Social Security heading into 2024. Moreover, despite having a 62-year low in unemployment in April of 2023, the federal deficit topped 5% of GDP this year. Previously, the only time the federal deficit topped 5% of GDP was in years when unemployment exceeded 7%, symptomatic of a weak economy. The question is, how much will this increase, or when unemployment rises from the long-dated predicted recession, where are we headed? Coincidentally, even as the US continues to let deficits grow, Europe is actually on track to significantly narrow its deficit. The IMF projects that US deficits for all governments will reach 7.4% of GDP in 2024 and in 2025. The IMF expects combined deficits of Eurozone governments to fall to 3.4% of GDP from 3.6% in 2022 and further to 2.7% in 2024. A couple of weeks ago, credit rating agency Moody's cut the US credit outlook from stable to negative. Their reasoning behind the cut was that they believe fiscal deficits will continue to remain large and debt affordability will continue to significantly weaken. Moody's goes on to specifically cite that the combination of higher interest rates and the continuation of political polarization within Congress raises the risk of them being able to reach consensus on a fiscal plan to slow this decline of debt. Since May's debt ceiling crisis ended, S&P has downgraded the US credit ratings, and now Moody's also has cut their outlook. So how do we fix this? Professor Kent Smetters of the Wharton Business School at Penn said we would need a 40% increase in taxes now and forever, or a 30% decrease in spending now and forever, or a combination of the two. In conclusion, the fiscal challenges facing Washington, D.C. are vast, complex, and unsustainable. The current path of growing deficits and mounting debt threatens the financial stability of our nation and the prosperity of future generations. The U.S. government currently has $33.7 trillion of debt. How much worse will it get before we make any significant change? Now, the dreaded recession word. While forecasters and policymakers see a cool down, the post-pandemic economy has been full of surprises. Heading into 2023, Wall Street widely expected a recession by mid-year. Instead, gross domestic product rose at a 4.9% annual rate in the third quarter, the fastest pace since 2021. According to the most recent quarterly survey conducted by the Wall Street Journal, economists from both businesses and academic circles have reduced the likelihood of a recession within the next year. The probability, which averaged 54% in July, has now shifted to a more positive 48%. This marks the first instance since the middle of last year that the probability has dipped below 50%. The newfound optimism is attributed to 3 key factors: a sustained decline in inflation, the Federal Reserve's decision to halt interest rate increases, and a robust labor market coupled with economic growth that has exceeded expectations. On average, economists anticipate a 2.2% increase in GDP for the fourth quarter of 2023. This represents a significant upward adjustment from the average 1% growth that was forecast in previous surveys. What is interesting is a number of leading indicators that historically have predicted previous recessions have been flashing red all year long, causing many economists to ignore the recent positive data and still believe a recession is near. Although, unlike the latest recession in 2020, this recession has been widely forecasted for years now, compared to the COVID-19 pandemic, which caught everyone by surprise. To finish with some good news, historically, when the Federal Reserve pauses interest rate hikes and before an interest rate cut, the market tends to react very positively. After the last 5 Federal Reserve interest rate increasing cycles, U.S. stocks on average have gained 23.4%. Core bonds, which have struggled mightily in the last 3 years, have been up 14% on average. This may bode well in the short term as we head into the end of the year. To wrap up, I would like to promote our next upcoming virtual education event, which will be more geared toward a younger audience. On December 20th, our own Luke Kraft will talk about the new school of investing to engage a younger audience. We think this would be a great for anyone who's 16 years or older to learn more about investing from an early age. Therefore, please send this along to your children, grandchildren, nieces, nephews, or whoever you may think might benefit from this material. In January, we're planning a market outlook event along with a wills and trusts event in February. Therefore, keep your eyes open for more information on these events, or always ask your financial advisor if you have any questions. On behalf of everyone at WDS, thank you so much for watching our fourth quarter market commentary and updates video, and we hope you have a wonderful holiday. Thank you again.